All right, guys, we are live. How's everyone doing today? Um, I'm ALP, a legendary path. I'm here to talk to you guys about all the aspects of trading. This is going to be a new series I'm going to be doing. In this collection, I'm going to start with my favorite topic, which is risk management. It's actually one of the most overlooked topics out there, and which is not too good in my opinion, honestly, because this is one of the main aspects of the psychology of trading, and without this proper grip on managing your own risk, you're leaving yourself susceptible to a lot of drawdowns that you probably wouldn't expect, or that you would expect that are calculated in your models, but you're just letting it slip because it's not a priority for you. Um, which is a big mistake, of course. All aspects of your trading should be 100% in this regard, especially the risk management aspect of it, which is probably not what people think risk management is. Um, in the grand scheme of things, risk management is you're a way to consistently deal with the losses that come with trading, because there are losses. There's no way around it. You will lose eventually. I like to tell people that start trading, um, I hope you lose. I hope you lose a lot to start, so you could understand that part of it. You could understand the pain before you start winning. All these crypto bulls that got into the market in like 2017 or whatnot, that just rode a huge bull run and just made substantial gains. Or you know what? Not even in crypto. There's topics like this in all markets. You enter when there's a bull run, and suddenly you only know how to trade one direction of the market, and you're left susceptible to the elements. Because markets work in cycles, and eventually you will get hit by the bear cycle, and you'll be holding all the way down, which is the case that happened to a lot of crypto traders and probably pot stock traders. The list goes on. There's a bubble for every market. Eventually the bubble pops. But how do you stay locked in when at any point during the trend? The best traders there are grind out that consolidation in the middle of a bear and bull market. They grind out that consolidation, and so when they have all their gains set up and they enter a trending market like a bull or bear market, they do insane gains on that amount that they've been working on for whatever time frame that the consolidation was. And it's hard to grind through a consolidation without proper risk management, just because the way to trade is different. In a bull market, you could just long every dip, and without much regard to proper position sizing, or what is it, and everyone feels like a genius. But in consolidating markets, that's not the case, and you will get chopped up, and you'll be pretty sad about it, and you'll think you are the problem, because you are, but you'll think also that the market's against you. So yeah, this topic is just to reinforce a super essential part of your trading. I don't see how you could be a good trader without it, because this is the part that once I learned to respect, that transformed me into a consistently profitable trader. And it's a super easy concept to understand as soon as you understand what it is, and then you'll be wondering, why was I so greedy in the first place? Why didn't I just focus on being consistently profitable? Because that's what your goal should be. If you're in a market to think, oh, I just need to make one play and then I'll be rich and retire, dude, you're playing the lottery. You should be focused on becoming a trader, an actual trader. You should be focused on becoming consistently profitable. It doesn't matter your time frame. It doesn't matter how much time. It doesn't matter if you work. Stop making excuses. You could play swing plays on the hourly, do your trades in the morning, come back at night, do your stop losses, your trade, your target prices. You don't have to stress that hard. It's not that serious. If you want to be consistently profitable, you need to be consistent. Obviously, why does that fly over the heads of so many? Well, because we want results, and we want results yesterday. So I'm gonna jump right into the topic. So basically, well, first of all, this isn't going to be one of the longest videos, because I'm going to be doing a collection on certain aspects of technical analysis, which precede this video. So this is just a precursor to all that content to make sure that you have the right fundamentals in play before jumping into actual decision making in the trades. This is more based around how to manage your stack without blowing yourself up. So essentially, what we should focus on is journaling. Okay, I know it sucks, but if you're a beginning trader, how are you able to determine what your edge is, what you're good at, what you're not good at? Are you able to remember your last shitty trade? Are you able to remember your last good trade? These are all important things that you're probably not too aware of when you're just starting off, because you still feel that adrenaline, that rush, but it's it they're not joking when they say you'll become emotionless at some point. And practice makes perfect. The more trades you put in, the more you'll get towards that goal of being disciplined enough to just understand that whatever happens, if the price goes up or down, it's all part of your plan, and you should have a plan. So the first thing you should do is just get a journal. You should journal before a trade, possibly during a trade and after a trade. But before and after, those are mandatory. During the trade could be a waste of time, depending on what your situation is. But it's optional. Personally, I just do before and after. I use Edgewonk, amazing platform, pretty pricey if you're just getting started. But that's a topic for another day. Essentially, journaling is just your way to understand what is going on and what has gone on and what is going to go on in a trade. If you're journaling and you see that something doesn't make sense on your setup, then why are you planning on entering a trade? You should be patient with your trades and enter only when you think that the edge is in your favor. And that's a big topic we're going to get into, is creating and refining your edge. Okay, your edge is equivalent to the edge that the casino has on you when you enter their premises. Okay, the house always has a better chance of winning, which should be your mentality when you enter the markets. Okay, you're here to just ride on the coattails of the liquidity providers and the whales. You're not here to run the show. You ain't shit. I'm not shit. None of you guys are shit. Okay, this is we're little shrimp in the ocean. Okay, we're trying to take little crumbs as we could. Eventually, those crumbs will get bigger. So it's just about knowing your place in the markets. We have no control over this. Okay, don't blame the market moves on liquidity providers or fucking manipulation or whatever the hell it is. The market gives what the market gives. Your only job is to take as much out of it as you could. So with that notion, focus on taking the best trades possible. You should be writing down your reasons for taking the trade, familiar setups that allow you to take this trade. How's your psychology doing in the trade? And after the trade is over, did it go the way you wanted it to? Did you take the full target price? Did you stick to your plan? You should not be panicking in the midst of a trade. You should not be entering and exiting, absorbing those fees. It's absolutely unprofitable to be jumping in and out of trades. The fees adds up, the commission adds up. You don't want to be on the flip side of that. So take your time and enjoy the process. And this goes hand in hand with proper risk sizing. So with that, we're gonna jump into stop losses. So I know this is a bit of a general concept, but we have an audience that deserves to know everything from top to bottom. So I'm going to be jumping into stop losses and how they relate with a proper strategy. So right here we're looking at the Bitcoin chart, XBT USD on BitMEX. This is the largest liquidity provider for Bitcoin. So we're always going to be charting the largest, the institution with the largest liquidity. So basically, this is just going to be random. I'm choosing a random part of the chart. Let's say, okay, this actually looks pretty nice. Let's say you want to play double bottom here or whatever it is. Okay. Your stop loss is basically your point of invalidation. If the price reaches this point, you are technically wrong, and you are happy with taking the loss that the stop loss is offering you, okay? And there's two types of stop losses, which is a limit order and a market order. Now, this should not go over your head. This should be really important to you, because one of these mistakes can wipe out your entire account. Okay, yeah, just the wording in market limit or market order can make a huge difference in your stop losses. Okay, um, basically a limit order is an order that will execute at that price and that price only. Okay, so let's say we're longing a double bottom and price would collapse and whatever. We'd get stopped out of this position at 95.65, okay? If this would be a limit order, that means our stop loss would be at 95.65. Simple, right? But that means the order will trigger at that level, okay? So as soon as the price, if the price would be continuously dumping, 95.65 would just get skipped. Sure, the stop loss order would trigger at that point, but as soon as it triggers, the price is already below that, and if it doesn't go back to that price, then you just got the position moved without you. So you're still stuck in this trade. Your stop loss didn't trigger, and now you're reaching even more for unplanned drawdown, which you probably didn't plan for. So in this case, I always think it's important to bite the bullet and go with market stop losses. Okay, market stop losses will exit will exit your position at any price as soon as it hits that price. So if price goes to 95.65, then your market stop loss triggers, okay? And that means as soon as this point is hit, it will be looking to sell at market value. So what could happen is it could go a bit lower. It will still sell at whatever price it went down to. It should be instantaneous. You shouldn't be getting slipped for long, okay? There are certain financial institutions or exchanges such as BitMEX that are notorious for slipping you a lot of points. That's why I do not use BitMEX. I use Bybit. More on that at the end of the video. And essentially, getting slipped is equivalent to having a limit order that just never gets triggered. So be wary of the exchanges that you use. You shouldn't be getting slipped on positions. That's a reason to completely stop using a certain product or service. Okay, so same thing with buys, honestly, with target prices. Honestly, you could also have a limit order, which would be as soon as price hits that level, you'll look to be exited. This makes a lot more sense, okay? Because a limit order is as soon as it gets to your limit order, it should be like a reverse sell at that level. So you should be taken out of the trade, and you should be receiving some nice commission off the trade as well. The maker and taker fees are in your favor because it's a limit order that is getting sold into you. But there are some platforms that have the target that have the TP as a market sell, which is quite odd. You don't want to be using that at all. You want to make sure it's always a limit order when you're exiting on a target price exit point, because you're going to be taking market commissions for no reason, and it adds up. You don't want to be taking that shit. So now that we got into the basics of what stop loss and target price is, we're going to be looking at how to fit your stack into the stop loss. Okay, so essentially the stop loss, like I said earlier, is the invalidation point of your trend. So you should be risking a certain amount that is comfortable within your system to be okay with getting stopped out. Okay, when I get stopped out, it's part of the game. I don't sulk over it. I understand. I look into the trade. I understand why it was bad, and sometimes you get stopped out on good trades, man. It happens, The market, you take what the market gives you. Sometimes the market gives you shit. You're not wrong. You're not stupid. Sometimes shit just happens, okay? Don't stress about it too much. That's why you need to risk a good portion that you're comfortable with, that makes sense in your own system, because eventually the inevitable will happen, okay? You'll get a big wick. God knows what could happen. Your risk always has to be managed perfectly. This is, before I enter a trade, I always make sure that my risk is managed. Okay, it's the first thing I think about. Okay, your primary goal as a trader isn't to make money. Your primary goal as a trader is to make good trades. The money comes after, okay? So, are you being a good trader by not analyzing your risk prior to entering? No, you're not being a good trader. You're not being a good trader at all, because that's one of the fundamental aspects of being a trader. So, you need to take that seriously. So, how do we add proper position sizing in a stop loss? Okay, I personally risk 1% of my portfolio on each trade. Okay, and you're thinking, why the fuck would I risk 1% of my portfolio? Okay, you as a person, if you've never looked into risk management, you could probably be throwing in as much as, well, as much as that could go into 100% of your portfolio, but you could be throwing in 25% of your portfolio into an asset. Okay, now how does that make sense? You're first of all, you're tying up all your liquidity, and then you're susceptible to losing 25% of your stack if God knows what happens. Okay, and God knows what often does happen in markets. Okay, you're not smarter than the market. So at that point, okay, you could build a strategy around risking a certain little percentage on your portfolio, because think about it. Okay, if you're risking a lot on your trades, it could come down to you're not pleased with how much you think you should be making, and you want a bit more. Whatever it is, you need to understand, if you can't grow a little account properly, how are you going to grow a big account? Even when you get to a $50,000 portfolio, are you going to be able to be happy with leaving a certain amount of money on a stop loss that's probably a lot more than you're accustomed to? You need to be trained to working with larger accounts, and you need to build it up from a little account. Okay, don't think building an account from 100K is the same as building an account from $1,000. Okay, it's not, because that money means something different to you. Now, as you get better, you'll get more emotionless, and you'll understand that that money isn't actually what I should be calling it. Okay, it should be my ammo. Okay, each trade I do, I'm shooting a bullet. Okay, and my ammo is my capital. If I run out of ammo, what am I going to trade with? So yeah, back to my point. When you're running a $50,000 account, okay, if you're risking 1%, you're leaving $500 on a stop loss. Okay, that means for every idea you're invalidated, you lose $500. Okay, so you're risking $500. And let's say let's use this for an example. Let's say your R is 3. Okay, your R is equivalent to how much you're risking. Okay, so if you're risking 500, your R is R equals 500. Okay, so you'll be seeing me and a lot of people talking about R is basically just your defined risk in a trade. So if we see that our ratio of profit to loss is 3, that means our R is 3R. Okay, and to risk 500, we're willing to make 1,500. Okay, without fees and commissions included. So that's just the main concept. Okay, and so yeah, think of yourself as a trader, and if you're a consistent trader, if you make actual trades, a trade every 2 days, okay, you're not an investor. Okay, this, first of all, I should have said this at the start. This isn't for investors. Okay, this is more for actually traders. Investors have a different strategy, but your risk management should still be priority. But for actual traders that are jumping in and out of trades every day, every couple of days, whatever it is, if you don't have risk management, you have nothing. So regardless, if you're risking $500 on a stop loss, do you feel comfortable with that $500 that's sitting on a stop loss? Put yourself in that mentality right now. If your stack is substantially less than 50,000, would I be comfortable even risking that 1%? What is that $500 to me? So these are all things you need to think about before you even get to that size of an account. Okay, is your psychology even going to be prepared for those type of trades? So how can you feel comfortable risking 5% on a $50,000 account? 5 times 500, 2,500. Okay, so you have 2,500 sitting on a stop loss when your portfolio is 50,000. That's 5%. Okay, if you lose that shit, you're down 5% on your entire portfolio. let's see. So here is Edgewonk's math cheat sheet. Okay, so you know when you play with risk to reward ratios and proper risk management, it's almost statistically based. It gives you a sort of comfort. You know, you're comforted by the statistics. You're comforted by your edge. You're comforted by your consistency. Okay, so if every trade you take is 3R, okay, you only need to win 25% of those trades to be profitable. Okay, you could do 2R trades and you only need to win 33% of trades to be profitable. How many trades do you win? Okay, and first of all, you shouldn't be winning 100% of your trades. If you're winning more than 75% of your trades, you're a god. If you're winning more than 60% of your trades, you're a good trader. Okay, don't get it twisted. You know, think about baseball. Okay, do any batters get hit every single ball that's thrown at them? Obviously not. Think about it. Same thing as trading. Okay. So with that we should always also look into drawdown. Okay, when you lose that 5%, you need to make a 5.3% just to get back to where you were. So if you're risking 5% and you get two trades, and you make two trades down in a row, you need to make 11.1% just to get back to that point where you already were. Okay, this is with fees and commissions included, of course. Oh shit, looks like Bitcoin's getting a nice little slam down over here. What's going on over here? Oh baby, damn, that's pretty interesting. Anyways, so yeah, so here we could also see how these streaks, these losses and these win streaks contribute to your portfolio. So if you're, this is quite obvious. If you're only risking 1%, you can make 10 trades in a row and you'll still be out only 9.6%. Obviously not only, but you shouldn't be fucking up 10 trades in a row. Let's say at most if you lose 3 trades in a row, which is a good benchmark, you'll be out 3%, and you can make that back in one trade if you're doing 3R. Okay. So same on the flip side, if you're risking 5% and you get those 3 wrong trades in a row, you'll be down 14.3% on your entire portfolio. And if your portfolio is a serious stack, we'll always use the 50,000 benchmark, you're down 7.5K ish. Okay, so focus on simulating the stack to be to make sense in your stop loss. Okay, so how do we simulate our stack using leverage? Okay, so that's something I want to talk about. Okay, so when people think leverage, they think, oh my god, multiplying my gains, yada yada. Also, multiplying your losses is something that they don't put into effect. Okay, the only way you should be using leverage is to minimize counterparty risk by leaving less money on exchanges, and also to make sure that you're that everything makes sense to you, essentially. So what I mean by that is that if you're inserting a certain percentage of your capital into a stop loss, okay, you don't have to leave all that money on the exchange. Okay, if your portfolio is 50,000 and an exchange is offering 100x leverage. Okay, first of all, before I get into this, let me just say, if you have all your stack on an exchange that offers leverage, and you're using that leverage to actually multiply what the valuation of your stack. For example, if you have a 50K stack and all your trades are on 5x leverage with the intent to trade at a level of 250,000, you're doing it wrong. Okay, and that if that applies to you, you will get wiped out eventually. Okay, so that should not be the way you handle things. Okay, if you're throwing in the equivalent of more than your portfolio is intended to be, you're setting yourself up for a very large drawdown. Okay, the use of leverage should be that you're able to leave less money on exchanges, and also you're able to fit certain position sizes within your stop loss. Okay, if your position size is, um, well, for a portfolio of 25,000, whatever your, oh sorry, 50,000, and you want to throw in $500 as your stop loss, where your risk is invalidated, which is based on technical analysis, by the way. Your stop loss should be based on technical analysis, not what you feel. It should be your invalidation point on the technical aspects of the chart. So yeah, you should be fitting that 1% into your stop loss, okay? And that's the beauty of leverage, that you're able to simulate a larger position size with less money on the exchange, okay? I never put more than 10% of my capital on an exchange, because what's the point if as soon as an exchange offers 10x leverage, I'm able to simulate my entire portfolio on the exchange, okay? So with that notion, why do I have to be susceptible to a hack or counterparty risk by leaving my entire stack when I just leave it in my cold storage where nobody could touch it, okay? Not your keys, not your coins, okay? Understand that. You always need to be aware of, counterparty risk. So essentially, back to the stop loss portion. If I want to, play a trade that has a certain stop loss available, I will just use a Bybit calculator or the BitMEX calculator or whatever it is to put 1% of my portfolio within the stop loss. Okay, that's all there is to it. And with that, you're able to take a scientific approach to trading. Okay, you're able to just go on percentages instead of looking at the dollar signs and whatever your system is. It's always much more efficient to consistently just simulate that position size in your actual stop loss. Okay, and as your portfolio gets larger, you're able to recalculate how much has to be on that stop loss. Okay, go for the 1%. Start off with the 1%. It makes sense. You'll be more comfortable, but it all comes down to you. So this is gonna wrap up my my risk management video. There will be more on the way, probably in the next week. I'll be doing a nice little series. This is eventually going to be remastered. This is just the first run at it. Eventually, also, I'll be branching out into different other aspects of risk management as well. It's going to be much more detailed. This is just a general video to start off my collection in trading videos. So yeah, that's going to be it for today. If you guys ever want to support me, I'll be leaving all my content out for free before. I did push out services out in the past. That's not the way I want to go buy things anymore. If you ever want to support me, if you ever want to say thank you, all you have to do is use my Bybit affiliate pro link. The link is going to be in the description. Like, comment, subscribe, the usual shebang. I won't take your money for anything. Okay, that's not what I believe in anymore. I just want to push out trading, how to make better traders. Even if technically you are trading against me, I am trading against you. It's better to have more liquidity in the game. So yeah, if you ever want to show your appreciation, use my Bybit Pro affiliate. It helps a lot. It helps a lot more than you think, and it's gonna let me keep rolling out a shitload of videos for you guys, which I'm looking forward to extremely. I'm looking forward to that extremely. Anyways, whatever. Fuck the verbiage. Anyways, yeah, thanks for tuning in, guys. I hope this helps you out a lot, because this is a topic that's quite overlooked. Like I said at the beginning of the video, it's quite overlooked for bad reasoning, because it's boring. Okay, but sometimes you need to do the boring shit to become the big shit. All right, have a nice day, guys. Ciao, ciao.